Hello, everyone, and welcome. As always, it's a pleasure to have you here. Without further ado, please join me in welcoming Louis Navellier, the editor of Growth Investor, Breakthrough Stocks, and Accelerated Profits, along with the founder and chairman of Navellier and Associates. Now, Louis is one of Wall Street's renowned growth investment advisors, specializing in behavioral finance and utilizing extensive quantitative and fundamental analysis to identify market-beating stocks. He's here today to share some of his expertise with us. So, Louis, with that all said, I'll go ahead and hand the mic on over to you. I'll be right here if you need me, but the floor is all yours.
Great. Well, it's an honor to talk to you folks today. I'm going to talk mostly about interest rates. Last week, the yield curve, the difference between the two-year Treasury and the 10-year Treasury, became the most inverted in over 42 years. And what caused the spike in Treasury yields last week was the ADP payroll report, which was the largest in some time. Then on Friday, the Labor Department's payroll report came out and didn't find the jobs ADP found. And so bond yields started to meander lower. And then in the wake of yesterday's CPI report and today's PPI report, rates are still going dramatically lower. So what's happening is the yield curve is still inverted, but now thinks the Fed won't have to raise rates later this month because they tend not to fight market rates. So market rates have come down immensely. And just so you guys know, the reason the CPI was so good is we cut off a big gain from June of 2022. It was up 1.2. So that's why the annual rate fell to a 3% pace. But the PPI was only up 0.1%, and the annual pace is only up 0.1. So there's core PPI goods fell 4.4% in the past year. So there's actually deflation on the wholesale level now. So we do think the pressure's off the Fed to raise rates, and but I do want to walk you through what's been happening with rates, and then I'm going to show you my best stocks and the best opportunities we have in the upcoming weeks. Okay, so let's talk about our Federal Reserve. They were estimating that GDP would be growing at 2.1%. They're now up to 2.3%. We're not hitting on all cylinders. Manufacturing is at has contracted 8 straight months. It's at a 3-year low, according to ISM. So all our growth in America is due to the service sector. Okay, and that's where all the growth is attributable to. And here's what the yield curve has been doing. A year ago, it was in yellow. That's called a normal yield curve, where short-term rates are lower than long-term rates. And then you can see in red, it was inverted a month ago. About a week ago, it was in blue. And then that's where we are in green now. So this was all done last week, so I apologize. It doesn't fully reflect the rate decline that we've had in the last 2 days with the favorable inflation reports. But we like to watch the 2-year and the 10-year yield, and we do not want the 2-year to be higher than the 10-year. So the curve is still inverted today, but it's not inverted by 100 basis points. It's more inverted by like 80 basis points. So, but that's still bad, okay, by all historical standards. And the Fed's real job moving forward should be to uninvert that curve. And just so you have an update, the 10-year yield, I'm showing this chart, is 406. It's about 382 and falling this morning. And the 2-year yield is about 466 and falling. All right, so let's look at what happens when the yield curve inverts, okay? This shows you how often it happens, and it often triggers a recession, which is the shading in kind of purple there. So a lot of long-term market pundits are insisting we have to have a recession because the yield curve is inverted. And I would respectfully argue that although we have certain sectors of our economy in recession, the overall economy is not going to go into recession because the service sector is too strong. By the way, in the strength of the service sector, a lot of it's boomers, a lot of it's retirement savings, a lot of it's people have a lot of cash, and the cash is burning a hole in their pocket. But when we take the 10-year minus the federal funds rate, we get this chart. And the 10-year minus the Fed fund rate and the 2-year rate, we get this chart. And again, historically, when we get these inversions, it triggers a recession. I'm respectfully arguing that we're not going to get it because of the service sector. And so the yield curve and monetary policy is very interesting. And, anytime we get this curve below the line there, bad things can happen. And this is just one of my arguments why the Fed has already tightened enough. Here's how the yield curves have behaved during previous financial crises. And you can see we're more inverted now than we were during the subprime meltdown. So again, the Fed has done enough, and I don't think I think they should just start to work to uninvert this curve. All right, let's talk about inflation. I apologize, I don't have the latest number, but in Europe, inflation is coming down, but they're running hotter than we are. In the U.S. through May, we're running at 4%. Now we're running at 3%. And Japan's cooling off pretty quickly too. So the good news is inflation is a lot less worse in America than it is elsewhere. Some of that's because we're energy and food independent. Some of it's we're just a big, very efficient company. We have Costco and outlet malls and all that stuff. But we're just more efficient. And then a lot of it's our currency. Some of these countries have had weaker currencies, and it's been inflationary for them. All right, the core CPI is running hotter than overall CPI, and but it did slip yesterday, so I don't think we should worry about it. I think we're about 4.6 right now. I'm having a senior moment. I don't remember it, but I think it's about 4.6. And there's something the Fed looks at called owner's equivalent rent. And that's been the stubborn part of inflation that's been reluctant to fall, but it was only at 0.4 last month in June. So that's a good sign. In previous months, earlier there was 0.8. The PCE, which is the Personal Consumption Expenditures Index, the Fed's favorite inflation indicator, has a lot less owner's equivalent rent. So we know it's going to be looking a little bit better here too. So inflation has definitely peaked. And on the wholesale level, we're bordering on deflation. All right, so this just shows you the CPI, the total without food and energy, but based on the Organization of Economic, this is all the countries worldwide. So inflation is more of a problem internationally than it is in America. Okay, here's what happened in America, just to be honest with you. This is probably the best chart I'm showing you. During the pandemic, we gave everybody a lot of money. We told businesses, oh, you want some money? We'll give you money if you pay your rent and don't lay people off. And a lot of independent contractors got money, equivalent of unemployment, even though they kept working. So the government threw money at people during the pandemic, and the money supply spiked, but you can see it's now negative. So the government's trying to undo what it did earlier, okay? And there's something called the velocity of money, how fast money changes hands. And I'm encouraged because the velocity of money has dramatically declined, okay? It did pick up in the first quarter. So, and I think you'll see a bigger pickup in the second quarter. This is the monetary base, just another way to look at all the cash on the sidelines and all, but the actual money, physical money supply has been shrinking. So that's good. So these are things that monitors do and people at the Fed do to try to bring inflation under control. And then here we divided the 10-year yield by the core CPI. And you can see we're near historical lows here, okay? So we're way oversold. The Fed does not have to raise rates. And I stand by that. And here's where the federal funds rate is versus treasury yields. Again, we're way out of sync where we were historically. The Fed does not have to raise rates. And when the Fed was raising rates, they were behind market rates. Then they shot above them. And because they're above market rates now, and market rates are falling since last Thursday, the Fed has overshot the mark, and that's why they don't have to raise rates later this month. Now, over in Europe, it's a little different. Um, Essentially, they finally got their ECB yields above the German 10-year government yields, but Europe's been behind us, so they may still continue to raise rates. Now, China's easing because they're in a recession now. China's imports and exports are declined dramatically, and so the second quarter China, numbers for China are not going to be very pretty. China may lie about it, but I just want you to know it's not going to be very pretty. So they were teetering on recession. Europe was also well, actually, Europe was officially in recession. Ireland contracted, Germany contracted, France had a bad month. Ireland is very sad. They have to kill 200,000 cows to comply with the uh, the global emission standards. So they have a big dairy industry in Ireland, and so you might want to stock up on some Irish butter because they got to kill a bunch of cows to comply. So some of the green stuff is hurting the economic growth. So here's the dollar. The dollar lost its mojo for a while. Now it's coming back. This is very important for you as investors because half the sales in the S&P 500 are outside America. So what happens is if the dollar loses its mojo, um, the multinationals actually make less money. So we got to be very, very careful. And domestic stocks do better than international. So, but right now it looks like the dollar is going to get stronger and stronger just because our economy is strong. Let's talk about how this impacts the stock market. So the talking heads are out there telling you that earnings are going to be down in the second quarter. That's true. The strategists have forecasted an earnings decline. However, the analyst committee is now finally revising their estimates higher. Now, this is probably next to impossible for you to see, but if you look to the right of this chart under June, you see there's a little green line that just picked up. That means we have positive analyst revisions, and they're starting to revise their estimates higher now, and the ones with positive analyst revisions are acting very, very well. The other thing is the market is broadening out. You may be aware that there are 7 giant tech stocks that hogged most of the money this year. And NASDAQ got overweighted uh, based on the laws that it had comply for indices. So what it is when you have more than a 5% weight in your index, you can't have more than 50% of the index in stocks that weigh more than 5%. So NASDAQ sent out a bulletin on Monday that they're going to trim the top 7 stocks in the S&P, in the NASDAQ 100 and redistribute it among the other 93 stocks. So they're going to announce the details of that on Friday after the close, and they're going to implement those changes on the 24th. So if you wonder why Apple and Microsoft and some of the others aren't acting as well as they used to, it's because they're going to get a haircut and be trimmed from the index. We don't know about the S&P yet. S&P has done similar things in the past. Sales growth is looking a lot better. You can see we got positive sales revisions, so that's a good sign. Dividends are still hot and heavy right now, as are buybacks. We have a 1% tax on buybacks right now, but they're looking awfully good. And so this is positive news. And guess what? The stock market is actually dying. Whether we're selling bonds or stocks, the amount of float outstanding is shrinking. So this is good. There's a lot of cash on the sidelines. It pours in. Fewer stocks. Market goes up pretty fast. So I do want to tell you how we structure our portfolios. My secret ingredient is this thing called an alpha. And what alpha is, it's how much the stock zigs when the market zags. So on a down day, we're looking for stocks are going up. Then we divide the alpha by volatility to figure out how much institutional buying pressure there is on the stock. Essentially, we're looking for stocks that go up on down days that don't have a lot of volatility. So this is my top secret quant thing that I do. And my research is online free to you folks. It's pretty obscure, but it's very, very important. Then we do a lot of fundamental analysis. I'm referred to as a fundamental quant, a behavioral finance guy. But what all this is all about is the chart in orange shows you a test of a fundamental factor. And you can see that we divvied up into 20 charts, but there was no real pattern here. The chart in blue on the left is a fundamental factor that's working a lot better. In fact, the top 4 bar graphs, the top 20% are the place to be. Although I could argue you could buy the top 45% and still beat the overall market. So we look for these blue charts, anomalies and inefficiencies in the market. And these blue charts today, anomalies and efficiencies are things like sales growth, margin expansion, earnings stability, earnings momentum, cash flow, return on equity, balanced earnings revisions, and earnings surprises. So then we grade the stocks in these factors to come up with the creme de la creme. And then finally, we optimize. Now, this is very confusing to a lot of people, but I'll do my best. We like to put 30% of our portfolios in conservative stocks. 60% of our portfolios in conservative stocks, 30% medium risk stocks, moderate risk stocks, and only 10% in the riskiest stocks. And we have a model, a computer model that tells us how to mix the stocks so we get the highest possible return, the highest alphas with the least amount of risk. And we do buy stocks that zig when other stocks zag on purpose to lower the risk of our portfolio. But the way the system essentially works is let's the stocks here in green or like get a 3% weight. Then they move over here to orange and they'll get cut to a 2% weight. And they go over here to blue, there'll be a 1% weight. So what our system does, it tells us to trim stocks before they get too risky. You may know in our newsletters, we're telling people to trim stocks all the time to take some profits and the stocks get more volatile. So we're very, very proud of this. We also have an allocation model on our website where our Platinum Growth subscribers will pick the risk they want to have, and it tells you how to weight the stock. We're very proud of this. So all my research is online free, and we have a dividend grader, but this is our stock grader. And we rank stocks on an A, B, C, D, and F basis. I wrote a book about all this when I launched these graders. The charts are knocked down by 1.75% a year, so I can comply with the SEC. But I do want you to know I'm very proud of this. Obviously, the A grade stocks are the best. They're in blue. B rated stocks are still buys. They're in red. C rated stocks are in yellow. And then D's are in like light blue. And then F are in purple. And the D's and F's are the ones to avoid. Okay. And so my research is online, available to you free. So you can go to navalier.com, sign up for our market mail, and click on Stock Grader. Or you can go to navaliergrowth.com, sign up for Navalier 360. It's a free newsletter, and then take advantage of our portfolio grader. It's the same database, they just a little different name. And here's some of the best stocks we have for you at this time. We have Darden Restaurants, because people are out and about dining more. We have Extreme Networks, very good stock. It's with the AI boom, it's moving to the cloud, so it's helping them a lot. We have Fortinet, FTNT, which is cybersecurity on the cloud. We have Genuine Parts, big distributor to the automotive industry. We have Lattice Semiconductor, LSCC. Lamb Weston is very interesting. This company's in Boise, Idaho, and they dominate French fries. And you may know there's a potato shortage, so your French fry costs have gone up. But anyway, you go to the supermarket, buy the Idaho French fries, and more than likely that bag came from Lamb Weston. They also dominate a potato distribution internationally. NVIDIA is a great stock. We've had it for a long time. Obviously, they're the big winner. They make the chips everybody needs. Quanta Services, engineering construction firm, helping with making the grid more efficient. The Biden administration is throwing out tons of money to put up alternative investments, alternative energy, and also improve the transmission lines for the grid. Supermicro Computer has been a huge winner. They put the NVIDIA chips on their fast servers. So again, the AI gold rush is moving to the web, and the web's getting faster and faster. So we have my firm management company is headquartered in Reno, Nevada, and I live in Florida. But the Out in Reno, we have we have the server farms out there. We have Apple, we have Google, we have 10 gigabit internet. They're all trying to get the internet faster now. There's 25 gigabit internet in Chattanooga, another big place where all the server farms are going. And Supermicro Computer just makes the servers more efficient and fast. The Biden administration is trying to figure out how to ban China from accessing our AI cloud. It's going to be very hard for them to do that, but we'll see. And finally, I do have a lot of integrated energy stocks. ExxonMobil will be the biggest, but I have ConocoPhillips, EOG. I've got Shell, British Petroleum. I got quite a few. And do have a lot of refiners that will make a lot of money from the crack spreads. And then I have some oil service companies. Just so you guys know, the stocks with the best margin expansion, okay, are energy stocks. So energy will not all energy stocks will be positive year over year, but we do expect big beats due to this dramatic margin expansion. And of course, a lot of energy stocks are making more money because they're actually producing more oil now. North America and South America are producing more oil, despite the horrible fires in Alberta that messed up the shale guys. All right, well, it's time to take some questions now. So why don't we start here? Here's a good question. Should I do gold or crypto? Well, I'd always rather you do gold, but just so you know, both those asset classes um, will do well when there's lack of confidence in central banks. So let's just say Jerome Powell breaks down and cries and begs for forgiveness, or Christine Lagarde, who runs the European Central Bank, you know, uh, doesn't run out of a press conference because she can't take the questions. Whatever causes a lack of confidence in central banks will cause people to put their money in gold and or crypto. There's a lot of fuss over the Bank of England. They're screwing things up. You know, in China, you can't get your money out. They dispatch tanks to suppress the protesters. So when you buy gold, I'd rather you buy physical gold, and I'd rather you not buy the coins. There's big markup with all the coins. So I'd rather you have the physical bars. You can get 1 ounce Credit Swiss bars, things like that. Okay, here's another question. Why don't we just buy the 8 best biggest stocks in Nasdaq? Isn't that where all the performance is? Well, that's a good question. And essentially, Nasdaq is trimming 7, but the 8th is Netflix, and they did hog all the returns through April. Then at the end of May, about 20 stocks in the S&P hogged the returns. So the market was broadening out. And then late May, June, we had the annual Russell reconstitution. So those stocks heated up. So we have a broadening market right now. So no, I don't want you to put all your money in just the big stocks. The other thing is a lot of it was short covering, especially on Meta's rally this year. Obviously, Meta is now profitable. They're guiding higher. What I find fascinating is the more these tech companies lay people off, the better their stock seems to do. Meta's had a lot of layoffs, and then Microsoft's also had quite a few too. But the reason those stocks are so firm is most of your money managers out there are trained to track an index, not beat it. So when they structure a portfolio, it's got to be 8% Apple and 7.6% Microsoft, etc. So a lot of these stocks just get bought blindly because the people running Wall Street want tracking managers. All right, here's a good question here. Okay, I got a gentleman here who's criticizing me on my energy bet. I thought oil was going to go to $120 a barrel. What happened? Well, obviously, Russia produced more oil, and China's economy contracted, and Europe did contract well, although it looks like they're firming up again. So, but it was really Russia. We were counting on Russia to systematically just go offline, and believe it or not, they actually produced more oil. Our biggest winners were in the tanker stocks that were transporting all this Russian oil all over the globe. 80% of the Russian oil goes to India and China to be refined. And then a lot of that refined product is resold to places like Latin America and stuff. Saudi Arabia is also storing a lot of crude oil offshore right now. There's 2 million barrels a day. Oil firmed up last week when Iran was trying to hijack a couple tankers. The U.S. Navy thwarted them, but they got some others. You know, the Navy's trying to have a bigger presence in the Strait of Hormuz and the Gulf of Oman. But generally speaking, you know, uh, we do have there's a piracy problem. Iran's part of the problem, but we're now in the middle of strong seasonal demand, and so I'm very comfortable with the energy stocks going into early September. And then we want to make sure that inventories remain tight. Just so you know, we are near 5-year lows on crude oil inventories and refined product. In the latest week, the inventories did rise again, but it's not uniform everywhere. In fact, in Cushing, Oklahoma, the inventories dropped. So that's that. All right, and we have another question here. Why did natural gas prices plunge? Well, they plunged 50% in November because the Northeast was warm. You know, I have a home out in the Mountain West. It was freezing out there. We had record snow. But now it depends how where natural gas is in the big metro areas. So because there's more people in the Northeast, that abnormally warm winter cut the demand for natural gas. Same thing in Europe. Europe used a lot less natural gas because their winter was abnormally warm. However, now you may know it's hot as hell, and the natural gas peaker power plants are coming on to provide electricity for air conditioning. So they come on during peak load demand. So natural gas prices are benefiting from this heat wave we have. Great question, by the way. So when you invest in natural gas, you just got to be able to predict the weather. So you want freezing cold winters in metro areas and hot, miserable summers, again, in metro areas. Okay. All right, here's another good question. What are the best AI stocks? Well, clearly it's NVIDIA, Super Microcomputer, that's SMCI. I like Extreme Networks. I like Rambus, RMBS. Um, those are just offhand some of my best AI stocks. Great question there. Okay. And then here's a new question. This is what about the FTC suing Chat GPT and stuff? Well, that just is breaking news today. I have to check that out, but I'm not too worried about it. Chat GPT was a very popular app. It's going to be upgraded and stuff, so let's not worry too much about it. But the FTC is looking for something to do after losing the Microsoft Activision case. All right, here's another question coming in. Um, how long should I hold stocks? Well, that's a great question. I hold stocks for long-term gains. So most of my letters, you'll see me holding stocks for 5 to 6 quarters. However, on our platinum growth portfolio, we have something called a 7-day portfolio for the top 10 stocks. So if you do want to trade more, you can trade those stocks. They're essentially A pluses, our highest ranked stocks. And it's been a very popular service. So I would recommend that if you want to trade more. Obviously, it's fine to trade in your IRAs, your pensions, and your taxable accounts, though. I'd strive for long-term capital gains and hold stocks a bit longer. All right, and just time for one more question. Here we go. What are the best sectors? Well, I like energy. Okay, I like consumer discretionary. I'm not big on consumer materials. Okay, obviously I have a lot of tech stocks. I'm more in the cloud and semiconductors. Okay, um, and then finally, to be honest with you, I have a lot of international stocks. I have a lot of shipping stocks because of when Russia has to transport its oil. It goes from the west coast of Russia all the way around out in the Horn of Africa up to India and China to be refined. Those boats are at sea for a long time, and then they also sell the refined product that India and China can't use. So and then Saudi storing oil on ships. So I do have a lot of shipping stocks, mostly oil transportation. If you want a good one, it would be Dorian. It's called LPG. Its symbol. It's a liquefied natural gas. You get a big fat juicy dividend yield over 16%, and then you have a lot of growth potential as well. Well, folks, it's been an honor to talk to you. would like to stay on schedule with the Money Show folks. But I look forward to seeing you at the live Money shows. I know there's one in Las Vegas in August, and of course, there'll be one in Florida after that. So I look forward to seeing you at the live shows. Take care, everybody. It's Louis Navalier.
All right, Louis, thank you so much. And just in time, it looks like. To those of you in our live audience, you heard him. Yes, we have a show in Las Vegas coming up. It is August 8th through the 10th at Paris Hotel. We'd love to see you there. And to those of you who are just joining us virtually, be sure to stay tuned as we do have a lot more in store for you today. I hope everyone has a wonderful rest of the day. And Louis, thank you again. Always such a pleasure to have you on.
Thank you.